Hey everyone, welcome back to Chip Stock Investor. I guess you probably know this is Chip Stock Investor because we look ridiculous again.
Don't be ridiculous. I am ridiculous.
But this time, it's not someone else's merch, it's ours. So we showed up for work today and thought, you know what, we should probably look like we're part of a team, part of a business.
Yeah, we're trying out some 30 Rock style product placement right here. But we have a great subject today, so please do not click off of this video. It's not all about Chip Stock Investor.
They already have. They're gone.
If you're already gone, you're really missing out because we're talking about an inflection point.
Whoa, inflection. Now they're going to think we're AI generated. But seriously, though.
For realsies, we do need to talk about this.
Yeah, something big is happening, especially in the US economy. You've probably heard us talk about the CapEx holiday in some of our videos of the 2010s. There was not a ton of new investment being made in property, plant, and equipment, long-lived assets, or the financing term capital expenditures, CapEx, in the 2010s in the wake of the great financial crisis. You can see here this chart from the Federal Reserve Bank of St. Louis. The growth rate of CapEx across the entire US economy in the 2010s from the peak in 2007 until 2019 was less than 3%, period of low investment in actual hard assets and infrastructure.
But especially after 2020, that growth rate has shifted pretty significantly, actually, 5.9% since 2019. That may not seem like a lot, but when you're talking about trillions of dollars, it is.
A lot of new money being invested in infrastructure, let's just call it that generic term, infrastructure in the US. And if you've been with us for a while, you've heard us talk about this a lot, and you probably have wondered, okay, that's great, but outside of data centers and everything AI data center related, when's it going to show up in the numbers? Because up to this point, it has been highly driven by a lot of things related to either directly or indirectly to the data center build out. Something big happened in January.
We don't necessarily focus a ton of attention on these particular numbers because we always want company data to back this up. This study provided by the Institute for Supply Management, ISM, the PMI number, anything over 50% indicates manufacturer sector expansion. Like we discussed over on Semi Insider last week, for us, that includes semiconductor manufacturing, not only things that follow into the IT sector. But this is a leading indicator for the economy. There was a 3-year downturn. US manufacturing is now finally pulling out of that slump. You can see the inflection point in January up this year.
Now, to be clear, we have had some false starts in this index at various points in time, including this time last year, right before the tariff tantrum hit the markets. But seeing a big dramatic jump like this, above 50%, is interesting and highly indicative of activity that we've been talking about now for some time. Namely, things like inventory of parts and pieces, inputs to produce actual final products and services, inventories in the economy, finally getting back down to low enough levels that companies feel comfortable to start purchasing again, because a lot of them got burned in the wake of the pandemic and especially the chip shortage in 2021 and 2022. So on the left, we have highlighted some of the commodities that are in short supply: electrical and electronic components, memory. No surprise there. You've probably heard of the memory shortage. We'll also add to the list optical components for networking. And Casey, we've mentioned this metric before, the book-to-bill ratio. Most companies don't report a book-to-bill ratio, but you can kind of deduce a very widespread average book-to-bill ratio from the chart on the right. We have new orders highlighted in blue. Right below that is production. So in January, manufacturing sector orders from customers actually rose to a higher level than production. That is another possible leading indicator that manufacturing is starting to heat up again when you have customer orders outpacing what you're actually cranking off of your manufacturing line.
So this report came out a few weeks ago, but no hot takes here at Chip Stock Investor. We wanted to wait for some earnings results to indicate that what was being reported is actually happening. So now we're going to walk through some of the companies that are participating in that. We'll start with big diversified integrated device manufacturers, or IDMs. And you'll note on the next few slides that we don't have a specific slide for China. That's because the industry is a little bit newer there, and they've kind of leapfrogged that IDM model, went straight to a more modern model like Fabless designer. And I guess the exception of that being the memory market.
Yeah, China, big player in memory IDMs. That's a topic for another time, especially when we get some actual news on that and not just rumors about what might be happening with China's IDMs and their relationship with the end market in the US in particular.
And another one we want to call out right here in China. Last month we talked about this over on Semi Insider. InnoScience, they have a deal with onsemi for their gallium nitride wafers for their power chips. So something to take a look at. But let's go ahead and walk through these now. This first slide that will show you diversified IDMs within the United States. Now, we've already discussed all of these companies, and they have shown that there is indication that the US manufacturing is heating up. Usually from Q4 to Q1, there is a seasonal decline. However, many of the suppliers, including Microchip and TI, are actually showing sequential increase. They're bucking that normal seasonality trend because of AI data centers, industrial power, and even a bit of recovery in auto.
We've had some write-ups and some videos on this topic recently, so you can find that elsewhere on our YouTube channel if you're interested. But let's jump over to Europe for a moment, because unfortunately, this is not yet a broad, across-the-board recovery for all the IDMs. Europe's IDMs historically are very closely tied with Europe's automotive industry, especially the auto manufacturing industry. And similar to the US auto industry, Europe's automakers are facing new competitive challenges from EV providers coming out of China. So that is affecting things a little bit. However, let's just take one of them here, NXP Semiconductor. In spite of that headwind for NXP, things actually are looking pretty good based on their outlook for Q1 2026. That's the bar on the far right of this chart. That is the actual midpoint of guidance from NXP. And on a year-over-year basis, they're expecting about 11% recovery in sales. So
it's not all bad. And we should note that some of these IDMs, except for Infineon, ST Micro, NXP, Bosch, all do have North American manufacturing presence, and that is likely where they're getting a lot of recovery.
Yeah, Infineon just sold its fab in Austin, Texas to Skywater Technology. The other ones still have presence in Texas. Bosch has a small fab in Northern California. So good stuff here, even for the IDMs in Europe that are perhaps a bit more delayed in recovery because of the European auto industry.
Something similar is happening in Japan, although maybe not quite as bad as Europe. They are doing a lot to shore up their own manufacturing. And historically, they were highly correlated to the auto industry, just like Europe. You can think of car manufacturers like Toyota and Honda being a huge industry for Japan. But Japan is responsible for a lot of technology in factory automation and robotics as well. Let's point out one company from Japan, Renesas.
Similar to NXP, a big portion of their revenue, almost half of it, not quite half, is indeed tied to automotive. But they are reporting a stronger recovery in industrial, IoT, and communications, especially that latter one, communications, on their earnings call. A lot of new product sales going to AI, data centers, and power infrastructure applications. So the bar all the way on the right, again, this is based on Renesas outlook for Q1 of calendar year 2026. Again, a pretty nice, sizable year-over-year increase expected in revenue for the company.
So those are the big diversified IDMs. Now let's talk about the smaller and more specialized power component IDMs. The reason why we separated these out is because these companies are more squarely focused on analog power and sensors, whereas the big diversified IDMs also have microcontrollers, discrete memory businesses. Renesas has that EDA biz that they acquired when they got Altium. The list goes on. But these are specialist companies. They're more basic parts, whereas the others maybe do a whole system design.
And as a result, these companies, on average, with the exception being on semi as a particular standout, tend to be much smaller than the bigger diversified IDMs. Let's take a look at one that we have not ever discussed here on Chip Stock Investor, Littelfuse.
So this company, Littelfuse, they are specialists in power protection. Even these smaller companies, highly allocated to industrial markets, not just automotive, are starting to report a return to meaningful growth.
Yeah, note here from their earnings call, their March quarter, Q1 2026, guidance implies 7% year-over-year organic growth, plus 5 to 7 basis points extra growth from a recent acquisition. A company like Littelfuse, they're actually highly acquisitive. It seems like every year or every other year for a decade, they have made a purchase of a smaller peer. So as a result, midpoint of their guidance for the March quarter is $635 million. Interesting to keep tabs on. This is one that harbors a small niche, as Casey said, in power protection. There is always that extra risk from companies that are constantly making acquisitions. Maybe an acquisition doesn't pay off. And indeed, Littelfuse did report an asset impairment charge, a write-down on a past acquisition they made some years ago, all the way back in early 2019. At any rate, the point here, also these markets outside of automotive tied more closely to industrial, including for this company, Littelfuse, data center, and more specifically, the grid and utilities that might be connected to a data center supplying it power, are also ramping up as we head into 2026.
I can't wait to hear from our viewers how we're actually supposed to pronounce that thing.
To the earnings call.
You know that doesn't mean anything.
I guess not.
Shifting focus to some fabless designers, we've talked about these companies very extensively on our YouTube channel. There's a lot of specialists here like AMD, Lattice Semiconductor. Also, both of those companies play in the FPGA market. Qualcomm for industrial IoT. They just completed that acquisition of Arduino that will help them with broadening that market, and Allegro for magnetic sensors. But let's spend just a couple of moments on a secular leader and market share taker, Monolithic Power.
Yes, the market share taker. You know you're doing something right if your revenue chart looks like this when there has been a cyclical downturn for all of your peers. So, for the uninitiated investor, they may see this and think, but all of you here at Chip Stock Investor know otherwise. The rest of the industry has lost some market share at the hands of some of these fabless designers like Monolithic Power. And like its integrated manufacturing peers, Monolithic Power is also saying it will buck the normal seasonal trend. Revenue is going to grow sequentially from Q4 2025 to Q1 2026. There to the right of that table, revenue expected to be at least $770 million, up from $751 million in Q4 2025. And another positive indicator here, a potential signal to take note of from Monolithic Power's management, the quarterly dividend is increasing 28%. You don't raise your dividend if you don't think you're going to have strong cash flow growth in the future.
Take a look at the left side of these charts. Revenue by end market. On the top, we have full year and then quarterly down on the bottom and highlighted in orange. Enterprise data has actually been down all year, but in Q4 saw a pretty significant acceleration. So what is this enterprise data segment versus storage and computing? Well, Monolithic Power knew that we would ask that question, and so they made a slide. Here's the breakdown. Enterprise data on the top left, logic chip portion of data centers. It includes power sources for GPUs and CPUs.
Yeah, that's right. Compared to the storage and computing on the right, that includes PCs and laptops, also SSDs and HDDs, hard disk drives in memory, as well as DDR5 and HBM memory for the data center. Again, power sources for all of these chips. So it makes sense that for most of 2025, storage and compute was up. There was a lot of ordering activity by the memory chip makers and their customers to power what has currently now turned into a memory shortage. But enterprise data, lots of companies have been ordering GPUs and CPUs as well. Why was that down and now suddenly ramping back up to growth at the tail end of 2025? Well, there's two things. First, we have Vera Rubin is coming later in 2026 from NVIDIA. And if you haven't seen it, we'll link it right here. We had that video a few weeks ago on high voltage data center architecture that NVIDIA is working on. This time next year, that should begin initial rollout. And so there was probably a little bit of a lull in this segment while Monolithic Power geared up for those developments. And now it is back in growth, pretty significant growth, probably going to happen in enterprise data for Monolithic Power in 2026. Last slide on this topic. This chart from Monolithic Power, it's a thing of beauty, really.
If you like bubble charts.
And your company in your portfolio is on the correct side of this bubble chart. It's a thing of beauty.
That's right. The size of the bubble represents the size of the competitor. So for instance, Monolithic Power is up there on the right in blue. Fantastic. The x-axis, that's the horizontal line on the bottom, 5-year average gross margin. And then the y-axis on the left side, the vertical line, is the revenue CAGR for these companies. So Monolithic Power, up and to the right on this chart, pretty fantastic.
High growth, high margins.
Monolithic Power.
What exactly is it that they do?
Kick names, take ass.
Yeah, that's right.
But what about that other bubble all the way to the right?
ADI, Analog Devices, I think they just had an earnings report, which by the time this comes out will have been covered on Semi Insider. But if only there was a YouTube channel that talked about ADI.
Watch this video right here. ADI, not boring.
And still relevant.